Webinar here at Stratton Markets. Today's webinar is going to be based on one of the widely used indicators, which is called Ichimoku. Now, that might sound extremely difficult to pronounce and may seem like an indicator which is extremely difficult to use. However, I can assure you that after watching this webinar, after half an hour or so, you will find it extremely easy to understand. And if anybody does not, they are more than welcome to get into touch with myself or one of the account managers in order to go into a little bit more detail with regards to how the indicator works. Now, to start off today's webinar, I would like to introduce myself as the market educator here at Stratton Markets. Just to give you a bit of a background, I have a background of being a financial advisor back in London, as well as other parts of the world. I won't spend too much time with regards to my experience. Really, I'd like to get straight onto the indicator and the market itself, as of course, this is going to be what is most important for you and your day-to-day trading. Now, if anybody does have any questions at any point throughout the webinar, they are more than welcome to ask towards the end of the webinar. At the end of the webinar, I will also display my email address. Feel free to send me an email also at any time. For anybody who is new to Stratton Markets, I just wanted to assure them that Stratton Markets is a fully regulated brokerage firm. Now, what that means is that they are following and abiding by European regulations and European laws. Stratton Markets is regulated by a regulatory body called CFDs. Now, just with every investment, there is a risk which is involved with regards to the capital you are investing. I widely recommend that anybody trading CFDs or trading here at Stratton Markets is fully aware of the risk which is involved in the investment. If they are not, again, feel free to get in contact with myself or your account manager. Now, today's schedule, we're going to be looking at the Ichimoku indicator, how you can use it on a day-to-day basis, different ways you can use it, things that it can benefit you on your day-to-day trading, and also things you need to be aware of when using it, things like false indications. Also at the beginning, we're just going to go through very quickly some basic Forex knowledge for any trader who has possibly joined for the first time over the last week or so. So first things first, what is CFDs? What is CFD trading? Now, it is pivotal before anybody is investing any capital into the financial markets that they are aware what CFD trading is. Now, CFD stands for contract for difference. CFD trading allows you to speculate on the rising and falling of prices of certain securities such as Forex, shares, and commodities. Now, with CFD trading, you are not buying the underlying asset, such as when you are buying, let's say, stocks or in an ISA or other securities, but instead you are simply buying a contract that is mimicking the movement of the underlying asset. So, for example, if you're trading Apple, you do not actually own a share in Apple. You are simply trading on the price movement. Now, the benefits of this is that you can easily enter and exit the market. You can take advantage of using leverage. And of course, you can trade in both directions. So you can trade both the price falling and the price increasing. Now, what is leverage? Now, leverage is when your broker is allowing you to control more capital than your actual investment. Now, for example, if you are investing $1,000 and you have a leverage of 1 to 100, that means you are able to invest up to $100,000 into the market. However, the risk, of course, is still simply limited to the $1,000 which you have originally invested. Now, margin equity and balance is something that you'll continuously see on your screen, whether you are trading on the MT4, the MT5, or our online platform. You always see these three words, these terminologies coming up. So first things first, margin, okay, is the capital which you have invested in the market. You'll also see something called free margin. Free margin is the capital which you have free left in your account to invest in other securities. Now, the equity in Forex trading is simply the total value of a Forex trader's account, okay? When a Forex trader has active positions open in the market, the equity is taken into account the profit and loss of those trades. Now, the difference between equity and balance is that balance is not taken into account open positions. Now, we're going to start to now move on to Ichimoku indicator. Now, Ichimoku indicator, I must express, is based on technical analysis. So, technical analysis is when a trader is analyzing the price movements in the charts. So, it's not taking into account fundamental analysis. So, what I mean by that is that it's not taking into account aspects of trading such as politics, such as economical data being released. It is purely taken into account technical analysis. Now, as stated, technical analysis is when you as a trader is trying to predetermine a pattern in the market and using that pattern to trade the price movements and to try and profit from those movements in the market. Now, let's look at an example, a very, very basic example of what I mean by technical analysis. This is a chart below, as you can see here. This is the British pound against the Canadian dollar on a 30-minute chart. Now, a technical analysis will be looking at this chart, which is a line chart, and trying to establish a pattern. Now, I can see a pattern. It's very, very clearly trading within a range of a support and resistance line, okay? This is what technical analysis is. It's looking at this chart, trying to predetermine a pattern. I've done it here, and I put two lines of where I think this price movement is trading between, something called range trading that we'll look at later on in the webinar. So what do you think the next movement is going to be? Now, based in a real life scenario, of course, it can continue to grow and increase in price. However, as a very simple example, based on technical analysis and this support and resistance lines which are plotted in the market, it would continue to go down. Now, Ichimoku. Now, the full name of the Ichimoku indicator is Ichimoku Kinko Hyo. Now, as I'm sure you can clearly see, it is a Japanese word. it is based on a Japanese theory. Now, Ichimoku is an indicator that is used to scale momentum along with future areas of support and resistance. Now, that might seem quite advanced and hard to understand. What that basically means is that this indicator is there to assist you to determine how the market is going to move next. It is there to assist you to determine trends, how strong the trend is, how long it's going to last for, and when the market, the price, is most likely going to find support and resistance. Now, support and resistance is probably the biggest part of technical analysis. Now, the indicator is an all-in-one indicator, and it comprises of 5 lines. They are called Kenjin Sen, Kiju Sen, Senku Span A, B, and Chiku Span. Now, that might seem completely foreign to you. Do not worry, we're going to look at it in our next slide. Now, these are the 5 lines which we previously mentioned, which is making up the Ichimoku indicator. Now, it is not necessarily pivotal that you know the name of these lines, you know exactly what these lines necessarily mean. The only thing which is pivotal for you to know is how to use them. Okay, so I will leave this on the screen for you. Feel free to pause the video. I am going to send you a recording of the webinar as well if you want to read through it, or feel free to do some research of your own as well in order to find out more about each individual line. Now, each line is a moving average, okay? So this is what I mean by the Ichimoku indicator being made up of different indicators, because each line is a moving average of a different period. So for example, the past 26-day periods, the last 9, and so on and so forth. This is what the Ichimoku indicator looks like, okay? So it looks like 2 colored areas. It will always be 2. It won't be more than 2. So we can see a red area here, a yellowish area here, red, yellow, red. Okay. Now these areas are called clouds. So if I am referring to the cloud, it is one of these 2 areas. Now you've got a bearish cloud, which means that it is going down. You've got a bullish cloud, bearish, bullish, bearish. Okay. Also, we have 2 moving averages. Okay. We got a slow moving average, which is the blue, and then we have a faster moving MA, which is the red. Okay. So when you are inputting the Ichimoku indicator on your chart, it will always look like this. Now you can change the color of the clouds and the indicators, but it will always look as it is on the screen at the moment. Now, how can you use this indicator in your trading? Okay, now there's different ways you can use it. The first way is using the clouds. So as I mentioned, these here are the clouds. Now what some traders are doing, okay, now I'm not advising you to trade this way. I'm simply informing you of different ways you can use the indicator. What traders are doing is using this indicator in order to find a point to enter the market. So we can see here when the price is moving above the cloud or below the cloud, it is signaling a new trend. Okay. Now, it is completely down to you as a trader how long you are going to keep the trade open for once it has crossed the cloud. So we can see it crossed the cloud here. So we've got 1, 2, 3, and 4. Okay. Now, on the first occasion, the indicator is not necessarily false because it did continue to rise once it moved across the cloud. Do not forget we're looking at a 4-hour chart. So this bar here is approximately about 30 to 40, possibly 45 pips. So anybody who is placing their take profit at that level would have made a profit, so would have been a successful indication. Anybody who's trying to make more profit, they would have missed out. Okay, so we can see once crossing, it continued to go up to this point. It had a price correction, and then it continued up a little further. We can see on the second occasion it crossed here, and it had a massive movement downwards. It had a bearish movement downwards. It went up to here. It had a 50% price correction and then continued to move down temporarily to about here. Now, this is about 100 pip movement, and down here is about 125. Okay, so anybody who was placing their take profit within that bracket would have made a profit based on that pip value. Same thing happens here. It crosses and is indicating a new trend, and the same thing happens here. Now, let's say, for example, if you're placing a 50-60 pip take profits, okay, you most likely would have missed out on this indication. So this trade here would have been a loss. However, if you have one trade being a loss out of 1, 2, 3, 4 indications, okay, depending, of course, how big this loss was, your profit and loss will be positive, which of course is the main aim here. So this is how you can use the clouds. Now, you can also use it as a moving average, okay? So use the Ichimoku indicator, use the moving averages instead, so the blue and red line. Now, bear in mind, the previous chart was the New Zealand dollar against the Canadian dollar, and this chart is the pound against the Japanese yen. So I'm using it on different securities, different currency pairs. I'm also using it on different charts. On this occasion, using it on the daily chart, just to simply show you that it's not only usable on a single chart. It's not a one-time occasion that it is showing a successful trade. Okay, you can use it on different charts. You can use it on different securities, and each chart is up to date, as you can see. So I'm not showing you something from 5 years ago. Now, using the moving average, okay, you're using it as a crossover strategy. So when the faster moving average is crossing over the slower moving average, you're placing a trade. So we can see it does so on 1, 2, 3, 4 occasions. Okay, so it crossed over here in an upward trend, it crossed over here in a downward trend, up and then down. Now, on this occasion, yes, it did go up. You entered at about here, it went down and then went up. It wasn't a very, very big profit here, probably about 30 pips. So again, depending on where you are placing your take profit and also your stop loss, because it did go down before going back up, would depend if that was a positive trade for you. So this first indication is a bit 50-50. Now, on this occasion, though, however, it is definitely going to be a positive trade for you. You're entering here, and it is moving massively, massively, massively down. Okay, So this is a massive movement downwards here. I'm not too sure how many pips it is here. Most likely going to be in the region of above 150 pips. Now again, it crossed over here. Okay, again, we're seeing a massive movement upwards. Okay, again, we're looking at about 150 pips. And on this occasion, it's looking at about 200 pips, okay? So we can see the first indication was a bit 50-50, but the next three were extremely positive, and they were large take profits in terms of the price movements. Another alternative is using both the moving averages and clouds. Now, if you are going to use the moving averages and also the clouds, it is deemed as a safer option, but you must be aware you're most likely going to find less entry points in the market. Now, what I mean by using both the moving averages and the clouds is if the price movement is above the cloud, so as it is here, as it is here, and as it is here, you are only entering buy positions. So these positions here. In these areas, you can enter buy positions. Now, in these areas here, where it's below the cloud, you are only entering sell positions. Okay. Now, the entry point is being determined by when the moving average is crossing over. So we can see a crossover here, but it's crossing over downwards, but it's above the clouds, so you cannot enter. There's a crossover here, but it's beneath the cloud and it's an upward trend. Again, you're not entering. There's a bearish movement here, but it's above, so you cannot enter. Now, this is an entry point here. You can enter here, okay, because it's a buy and it's above the cloud. Now, on this occasion, you're entering approximately here, and yes, it is moving about 45 pips upwards. So again, depending on the take profit you're placing, if you are using the take profit, you might not be, then it possibly could be a positive trade for you. Here, you wouldn't enter because it's a bearish and it's above the cloud, and then you don't get another crossover. You get one here, but again, it is below the cloud, so you're not entering on this occasion either. Now, I get asked a lot of questions with regards to what chart you should be using. Now, I'd like everybody to know that there is not a correct answer to this. You can use whichever chart that you wish to use. However, 99% of the time in Forex, you are only going to have available to you the 1 minute chart, the 5 minute chart, the 15, 30 minutes, 1 hour, 4 hour, daily, weekly, and monthly. That's not fixed. It is possible that a broker can offer you a different chart, but 99% of the time, these are going to be the charts available to you. Now, it is completely up to you which chart to be using. However, most traders and most analysts, which you're going to find on YouTube and on Google, are going to advise you that the 4-hour chart and the daily chart is the chart which is going to give you the most precise information. It is the charts they advise that your indicators are going to work best on. They're going to be more accurate on these charts. This is what they are advising. However, it is something that you yourself need to do your own research and analysis on, and also look at your own account to determine exactly which chart it is that you wish to be looking at. You do need to look at the size of your account also. You need to look at how much capital you have in your accounts. Now, if you're looking at the 4-hour charts, the daily chart, the weekly chart, there's likely going to be a lot of volatility and movement, possibly even against you, before the trade starts to move in your favor. If you've got a small account, it is something that possibly might not be appropriate for you. Possibly. If you've got larger accounts, maybe there is more time for you in the market and more space for market volatility. So you also need to look at exactly which charts you're going to use, but you also need to have a look at how much capital you have invested in your account. Now, using a mixture of indicators, I've always been a fan of using a mixture of indicators. Of course, it is completely down to you how to be trading. You might want to be using indicators, you might not want to be using indicators. Some analysts are analyzing the markets blindly, so it's completely down to you. What a lot of traders are doing is they're using more than one. It is, in a way, kind of viewed as getting a second opinion. Okay, so it is completely down to you exactly how you're going to be trading, which indicators to use. It is a way, in a sense, of spreading the risk, getting a second view, in a sense. Okay, so for example, if the Ichimoku indicator is signaling a buy, you're using the RSI, for example, or another moving average, or a zigzag indicator, maybe the Fibonacci indicator, to make sure that you're not entering the market at a point of resistance, possibly support. Now, I spoke about trading the range previously. Okay, now trading the range is a popular strategy which a lot of traders do use. It's a strategy which is incorporated in different strategies as well. Now, trading a range occurs when a security trades between a consistent high and low price movement in a period. The top of a security's trading range often provides price resistance, while the bottom is typically offering price support. Okay, so we can see that the price, in a sense, is trading within this range. Okay, now it is basically looking at the support level of the market and the supply level of the market. Now, when looking at the charts, it is something that you can do is you can look at the range. What range is the price moving between? Typically, you're seeing that there is a range, normally, not always, and it doesn't always stick to the range, but you do tend to see that a security is trading within a range during a specific period of time. And you can use this as finding entry and exit points, when you should be entering the market and when you can possibly exit the market. Now, I wanted to be very, very clear to everyone that indicators are not 100%. So it's important to have a trading plan, to have a risk management plan as well, so that you're not over exposing yourself to specific indicator, to specific security. So please speak to your account managers or seek some kind of financial advice with regards to how you should be spreading the risk, mitigating your risk, to have a risk management plan, to have a trading plan, because indicators are not always 100%. So you have to be fully prepared for that. Now, I want to also speak partly with regards to fundamental analysis. As I said, the Ichimoku indicator is solely looking at technical analysis, which is why I wanted specifically to talk about fundamental analysis. It's important to be looking at both. It's a way, again, of spreading risk and adding extra surety to your trading. Now, fundamental analysis is the analysis of economical data, news, events surrounding a currency or commodity or stock. So it could be anything with regards to employment figures, GDP, with regards to politics, or simply supply and demand. It could be anything within that region. Now, this analysis is designed to predetermine how the market is most likely to move next. So, for example, if you're trading stocks in Amazon, and then Amazon today come out and say their profits have increased by 10%, most likely, maybe not always, but most likely, the stock is going to increase in value. If you're looking at that news and you're trading based on that news and analyzing the market based on that news, then you are analyzing the market using fundamentals. Now, this information can have an effect on supply and demand, which is causing the price volatilities. And you can, of course, look at macroeconomics and also fundamental economics. Both will have a similar effect on the market volatility. Now, while fundamental analysis is most often considered factors that are relating to specific stock or commodities, currencies also have, in a sense, fundamental analysis as well. You do have news coming out with regards to the economy and with regards to politics, such as Brexit, for example, or a European bailout, okay? This type of things can affect currencies, okay? So the Ichimoku indicator is a great indicator, in my opinion. Test it on a demo account if you wish to do so, or ask us with regards to some questions about it, maybe queries you have on how to use it. But also it's important to have your trading plan, your risk management plan, and to also be looking at the market, so fundamental analysis. Now that brings us to the end of today's webinar. Today's webinar was based on the Ichimoku indicator. We touched base partly on other aspects as well. If you do have any questions, please feel free to email me at mihalis.e@strattonmarkets.com. I hope everybody found today's webinar informative, and it helped you with regards to understanding the Ichimoku indicator. If you do have any questions, please let us know. In the meantime, thank you for watching today's webinar. Trade responsibly and trade safe. Take care.